Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at AusBiz as we get across what has unfolded globally overnight. Stocks rising while gold rallied to a new record as the US dollar weakened. On Wall Street, all three major stock indices there registering record closing highs for a third straight session, boosted by tech shares. The NASDAQ led the way despite concerns prompted by President Trump's announced $100,000 fee for H-1B visas, which allow US employers to hire foreign workers in specialty fields such as technology and engineering. It is a move criticised by tech companies because it could limit access to highly skilled workers, and we did see some of the majors there fall. Whereas Nvidia shares jumped after the chipmaker said it would invest up to $100 billion in OpenAI and supply it with data center chips, linking to the highest profile players in the AI race. Shares of Apple rose after Wedbush raised the stock target price there on strong demand for iPhone 17. Australian founded Bitcoin miner Iron leapt, seeing its market cap almost double over the past month to close to $11.5 billion US dollars. Shares in Kenvue, the parent company of Tylenol, fell, extending the company's year-to-date loss to 21% as President Trump warned against the use of the drug in pregnancy over unproven autism claims. Disney shares fell further after the entertainment conglomerate announced talk show host Jimmy Kimmel would return to the air on Tuesday, having been suspended for comments over Charlie Kirk's shooting death. And US listed shares, the gold miners tracked the higher bullion price. Well, in fact, let's get across what we're seeing at a macro level. A new Federal Reserve Governor, Stephen Miron, has said that the central bank is misreading. We'll get to Steve in just a moment. Let's just get across what we're seeing at a macro level. New Fed Reserve Governor Stephen Miron has said that the central bank is misreading how tight it has set monetary policy and will put the job market at risk without aggressive rates. The upshot, he says, is that monetary policy is well into restrictive territory, leaving short-term interest rates roughly 2 percentage points too tight. Risks unnecessary layoffs, he says, and higher unemployment. Whereas that opinion is at odds with some of his colleagues who feel the central bank needs to remain cautious about inflation, with Raphael Bostic saying concerned about the inflation that's been too high for a long time. And so today I would not be moving in favour of it, but we'll see what happens. Whereas Alberto Muslim saying, I supported the 25 basis point reduction in the policy rate last week as a precautionary move intended to support the labour market at full employment and against further weakening. However, I believe there is limited room for easing further without policy becoming overly accommodative. Well, markets are pricing in a 90% chance of a 25 basis point cut at the Fed's meeting, and US rate futures have priced in 44 basis points of cuts through to the end of the year. The US Treasury yields have ticked higher as the market remained cautious about the Fed's next rate move. The 10-year up at around 4.14%, the 2-year hitting a 3-week high at around 3.6%, and the US dollar index fell on the day, the Aussie trading at around 66 US cents. Right, well, let's get to that man that just flashed up on screen. In fact, Steve Sosnick now joining us from Interactive Brokers. He is the Chief Market Strategist there. Steve, welcome back. Good to have you on the show. Let's first start with that Fed speak. There's plenty of it at the moment, of course. Who should the market be listening to at the moment?
Well, good morning, Andrew. I've always sort of come on the side of Governor Bostic, the Atlanta Fed president. He and I seem to always be, thinking the same, more or less along the same route. I understand Dr. Myron's point of view here. He's been recently appointed by the president. He got in the job because he's echoing that viewpoint that rates are too restrictive. I keep raising the question, restrictive based upon what? It's certainly not impinging upon asset markets. It's certainly not impinging upon credit spreads, which are record tight. Certainly not impinging upon a whole bunch of other speculative type of moves. Bitcoin today went down a little bit, but that's, again, over $100,000. So I'm going to argue that it's really not restrictive of anything. Maybe you could argue restrictive of, on real estate. But again, that's more driven by the 10-year, which went up. The rates have gone up there since the Fed meeting. So because the Fed is not particularly seemingly concerned about inflation, which I think I mentioned to you last week, it was the fourth month in a row where both core CPI and core PCE rose slightly. So, and they're running over 3% on an annualized basis. So, this is going to be a political tug of war going forward. But I think I think the I'm not going to even call them hawks. I'm just going to say that the non-exceedingly dovish members of the Fed are going to preach a little bit of caution here because inflation is not tamed, and if we get too easy, it's really runs the risk of getting out of control.
So, Steve, how comfortable are you with that momentum we're seeing on equity markets on the prospect of further rate cuts to come?
Here's the thing. Right now, the narrative fits the mentality of the market. So the market wants to go up. So if rate cuts are today's excuse, that's great. If it's more AI spending, that's what it is. So be it. It's really just putting a story that fits the preferred outcome onto the news. And so I think the Fed futures markets have been ahead of the Fed almost constantly. All year they've been looking for 2 to 3 rate cuts. Maybe we get it, maybe we don't. It was actually looking for more at various points. Remember last year it was looking for 8. So there's always a little bit of residual hope in there that rate cuts will come. Interestingly, the dot plot from the Fed doesn't have a lot of rate cuts for next year. They're sort of, the median is 2 for this year, but actually more, just as many Fed, remember what a median is, more than as many think rates are not going to come down with 2 rate cuts as think that they will. The outlier, of course, is Dr. Myron. At least we assume it is, because there's one dot that's way out of line with everybody else's. But if we look forward, the Fed is not predicting that they're going to need to cut rates too much. So I think once again, the stock market is euphoric, and so if rate cuts are one of the excuses for the euphoria, that's what it's going to be. I'm not particularly comfortable with it, nor am I particularly comfortable with just rallying on endless AI spending without regard to profitability. But again, that's not, that's being a bit of a stick in the mud, aren't I?
Well, not necessarily, but maybe it's realistic. Yet, certainly AI spending has been a big part of what we've seen on that rally for equities. And you only have to look at Nvidia and what it's doing. It's on a buying spree at the moment, isn't it? Obviously, taking a 4% stake in Intel and now $100 billion into OpenAI.
Yeah, Nvidia is really like at the center of this web now. Where they basically are more or less funding these companies with the hopes of them buying their chip. I understand the idea of solidifying your ecosystem, but for example, in the case of investing $100 billion up to $100 billion in OpenAI, well, that's wonderful, except OpenAI burns cash. At least the last report I saw was as of May, where they expect to lose about $44 billion and don't expect to be profitable for several years. And their revenues are about $13 billion a year estimated. So how are you going to come up with $100 billion to spend with Nvidia and then, oh, by the way, spend $60 billion a year at Oracle? I'm starting to get the vibes of like the bandwidth explosion that we saw in 1999, and I wrote about that today on ibkrcampus.com, which everybody's welcome to click into. And basically, I think back about Global Crossing, I think back about Northern Telecom, these companies that were riding very high on the bandwidth expansion, with Cisco sort of being the main router of them all. And ultimately we needed to find a way to make it profitable. Now, to be fair, 2 of the companies that were driving the great bandwidth expansion were Enron and WorldCom, which proved to be outright frauds, and that made it a lot harder for Global Crossing and Nortel to compete. And I'm not accusing anyone of fraud here. Let me be very clear about that. But I do think that as we start to see this kind of overbuilding without regard to where the money's coming from, because ultimately somebody's got to give the money to OpenAI for them to spend it all, both with Nvidia and with Oracle. Where's that money coming from, and how much are investors just willing to continually throw at this?
Well, do you put this in context that, this is only the beginning of what is perhaps potentially the largest industrial revolution the world has ever seen? And
before that, it was the internet, and the internet was everything that everybody everything that the most bullish estimates were going to say about the internet came true. But that doesn't mean that those initial investments weren't misallocated in the beginning. It took a period of time for that to all come into fruition. Also remember, the two companies that are the biggest, that best exploited the internet for profit potential, and I mean, don't mean exploit in a bad way, I mean turned the internet into money, didn't exist during the internet bubble, because I'm talking about Alphabet, Google, and Meta, Facebook. They weren't around then. So I think right now, just the assumption that OpenAI is going to be this dominant company, despite the fact that they're not necessarily making enough money to justify the expenditures that seem to be coming down the pipe, it has that rhyming element of history. I don't think it's going to repeat, but it's going to rhyme. And I think that what you're saying here is the two things can both be true. AI can be a revolutionary technology, and look 20 years from now, and we'll be amazed at how we lived without it. But at the same time, that doesn't mean we're not overbuilding on data centers and other infrastructure that have yet to really turn themselves into profitable investments.
Steve, almost out of time. Just briefly, we have seen big moves in precious metals, of course. What do you make of those? Is it realistic to think that perhaps gold is going to have a 4 in front of it by the end of the year?
Oh man, it's possible. That was like, it seemed unimaginable. And to be fair, I always have had a bit of an allocation in my personal account to gold, but this is a bit much, and in terms of the momentum here as well. The difference with gold is right now it's a bit more finite than stocks in many ways. Also, I do think you have this momentum of central banks moving money away from U.S. dollars and into gold as a key element of their reserves. I think right now it's definitely extended. It's got a little bit of elements of a parabolic type of move, but it's one of these that it's a freight train, and it's very hard to stand in the way of it.
Steve, always great to get across what you're watching. Thanks for joining us from Interactive Brokers.
My pleasure, Andrew. Thanks.
All right, let's come back locally, see what is ahead for the local market. Look as though we're going to build on yesterday's gains. SPI futures up almost 0.25%. Stay with us because we're going to get right across that in just a moment.